How do you calculate the intrinsic value of a business using a dividend discount model? For dividend investors, this is one of the best ways to estimate the value of the stocks you're considering buying. It's also a question that's been plaguing Who-Man. He watched a video that I posted a long time ago and is very confused about what we mean by R, what we mean by G, and it seems like his professor has asked him to find the value of JNJ's stock. And he says he's very confused about the values.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
So in this video, Who-Man, we're going to make sure you get an A+ on your assignment. Don't let your professor watch this video. So we're going to help you out. We're going to value J&J stock. And for those of you not in class actually trying to apply this, we're going to build a calculator for estimating the value of a business using dividends. First, let's just grab a hold of the logic of what a dividend discount model is trying to do. Okay, so let's say this is you here, college student with your cool hat. So let's say you got an offer from your uncle. He's going to give you $10,000 in 1 year. So the question for you is, how much should you offer to give your uncle today in exchange for this $10,000 in a year? Well, first of all, obviously you're not going to offer him anything more than $10,000, right? Because that would mean you're going to lose money. That doesn't make any sense. But what if you were going to give him $10,000? That also doesn't make any sense. You're going to let him use this money, $10,000, basically for free. You're not going to have it for a year, and then you're just going to get it back. So that also doesn't make any sense. So what is the value of this $10,000 in a year? Well, it depends on what rate of return, or R, this is required return. Whatever your required return is will affect how much you're going to pay for it. So let's say you wanted to make a 10% return. Well, in that case, you would take $10,000, which represents your cash flow, or in a minute, this is going to be our dividend. But so our dividend cash flow in 1 year is $10,000. And we're just going to divide that by 1 plus whatever your required rate of return is. So in this case, it's 10%. So we're going to put in 0.1 here. And when we calculate that, we come up with $9,090. So if you pay your uncle $9,090 today, and he pays you $10,000 in a year, you will make a 10% return on your investment. So let's say you don't need 10%. Instead, you only need a 1% return. So now we can do the same calculation. This time we're going to change our required return to 0.01%. And when we take 10,000 divided by 1.01, we get 9,900. So if you paid 9,900 today and got $10,000 in 1 year, you would make a 1% return. So, Who-Man, your R is what you want to make on the investment. It could be any number, whatever you need to make it worth your while. So now we're going to take the exact same principle, the cash flow that you're getting from your uncle or from wherever, in this case dividends from Johnson & Johnson. We're going to calculate what are the total dividends that you're going to get over the life of the investment, and then we're going to back that into what you should pay for it today if you want to make 10% return on your money. How much would you pay for Johnson & Johnson today in exchange for those future cash flows? So first, we're just going to start with the dividend per share, which for Johnson & Johnson was $4.19. So just open Excel and we're going to make a year column and a dividend column. So in the first year, we're going to make $4.19. And then in this column, we're going to do discounted dividend. And so what this represents is how much you're going to pay today in order to get $4.19 in a year, just like we did with your uncle. So the question is, how much are we going to discount it by? So that's our R, or required rate of return. And let's just say that you're wanting to make 10% on your investment in Johnson & Johnson. Okay, so we're going to just do equal sign, the dividend. We're going to divide that by 1 plus F, which is 10%. We're going to close that off, and then we're going to take that little caret to however many years away this particular cash flow is. And then let's go ahead and add dollar signs here, which will lock the F cell, and then hit enter. Okay, so if we pay $3.81 per share for Johnson & Johnson and collect $4.19 in a year, we'll have made 10%. And let's say we think Johnson & Johnson can pay the same dividend for the next, say, 50 years. So let's drag this all the way down, and let's drag the dividend all the way down. And we're going to also drag the discounted dividend all the way down. And you can see that over time, the discounted dividend is declining. And again, the reason is because you're taking a longer period of time to get this $4.19 back. So that means you're paying less for it today in order to still make 10% per year. So here we have it. We can calculate the value of Johnson & Johnson under this scenario. All we need to do is sum all of these discounted dividends up, and that gives us an estimated value of $41.54. However, what we notice with Johnson & Johnson is that its dividend doesn't stay constant. They've increased their dividend every single year for the last several decades. So we're not going to estimate a flat dividend payment. We're going to estimate that Johnson & Johnson is going to grow the dividend in the future. So in this case, let's say we're going to be conservative and we want to use the slowest they've ever grown the dividend in the last decade, which is here, 5.3%. So now we're going to make a new column for growth and call it G. We're going to add 5.3% as our estimated growth rate for Johnson & Johnson. So now all we're going to do is take our dividend from last year. We're going to multiply it by 1 plus whatever our growth rate is, and then go and lock that cell down so this doesn't move, and then just drag it all the way down. So now we have a dividend that's growing each year by 5.3%. And then we're discounting that growing dividend again at 10. And that gets us to an estimated fair value of $79.11. So we can put a V value here and just make this equal to this. So there's one other thing I might point out here, and that is this required rate of return. Again, this is completely up to you what you put in here, but I think it's probably fairly unreasonable to expect stocks will make 10% per year going forward, specifically if you're looking at a stock like Johnson & Johnson, which is very low risk. So if you want to impress your professor, let's go ahead and do a little more detail on this required rate of return. So we're going to do two things. One, we're going to say, what is the estimated return of the market, right? So if you just invested in the S&P 500, what would you earn each year? And if you look back at history, stocks have historically earned about 4% more than whatever the 10-year U.S. Treasury earned. And we know that the current 10-year U.S. Treasury is 3.1%. So if we just say, okay, stocks are going to make, say, 4% more than that, we come up with 7.1%. So if you wanted to match the same return as the market on Johnson & Johnson stock, you can put in 7.1 into R. And you can see that the less you require your return to be, the higher the estimated value goes. However, there's one other thing to consider, and that is that Johnson & Johnson is probably not as risky as the average stock. So what we're going to do here is look at the 5-year monthly beta of Johnson & Johnson, and you can see it's 0.66. So in other words, for every 10% the market would decline, we would expect Johnson & Johnson to decline by about 6.6%. And conversely, if the market goes up 10%, you would expect Johnson & Johnson to go up 6.6%. So J&J is not as risky as the average stock. So we can take this beta of 0.66 and calculate kind of a risk-adjusted return. What do we need to match the market's risk-adjusted return? We can simply take whatever we think the S&P will generate, multiply that by the beta, and that gives us a 4.7% required rate of return. So if we put in 4.7%, now the value of Johnson & Johnson jumps all the way up to 231. And then if you really, really want to impress your professor, you can also do a margin of safety value. Now, this is something that Ben Graham always argued for. Thought process here was you should never pay exactly what you think a stock is worth because your estimates could be off. So we could be expecting a 5.3% annual dividend growth, and maybe Johnson & Johnson only comes up with 4, right? And if they only do 4, now we've missed our value by about $60 a share. So what Graham suggested was taking the value and reducing it by, say, 20% or 25% or something. And if you pay that price for the stock or less, you basically have built in a margin of safety to where if one of your inputs was off, you still might not have made too big of a mistake. So let's just say this multiplied by 0.75 if you wanted 25% margin of safety. And that would suggest you would want to buy the stock at $173.21 or below. If you did that, you would expect that you're going to make at least a 4.7% per year rate of return if Johnson & Johnson is able to grow its dividend at 5.3% per year for the next 50 years. The dividend discount model is a classic model and can be very helpful specifically for businesses that have a very stable long-term estimated dividend. For those that don't, or maybe don't pay a dividend, you have to use some other method, namely a discounted cash flow model. So if you're interested in seeing that or other valuation videos, let me know in the comment section down below. Thank you to everyone that supports me on Patreon and on YouTube. I do provide all supporters with early access to videos ad-free and also some additional content that I don't publish on my main YouTube page. So if you're interested in that, consider supporting the channel. I'll put a link right here. I will see you in the next video.